हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 109 107 32 which talks about financial instrument part 9. So in previous session we had discussed about the derivatives, its features of derivative. Then we had discussed along with various examples definition of derivative. We had discussed about the characteristics of derivative. Then we had discussed about the own derivative in case of own use agreement. In case it is a net settled, then it is a derivative in case of gross settlement. In case of non-financial instrument, if it is to be settled on a gross basis, then it is not a derivative. Exemption is provided as per INDAS 109 to the non-financial instrument in case if it is settled on a gross basis. Then we had discussed about the various accounting treatments in case of option holders, in case of option writer. Then we had discussed about concept of non-financial instrument. This we had discussed in our last discussion. Today we are going to discuss about the equity derivative, how equity derivative is to be measured, how it is to be accounted for as per the standard. So equity derivative is what? Equity derivative is an obligation to deliver cash. It is an obligation to deliver cash. Suppose A Limited, who is an option writer, gives option to B Limited to sell fixed number of equity shares for rupees 500 crores after 2 years. Means equity derivative. Let's take example to explain how it is to be accounted for as per the standard. So suppose A Limited, who is an option writer, who gives option to B Limited, who is holding the shares of A Limited, to sell fixed number of equity shares for rupees 500 crore. Here number of shares are also fixed and consideration is also fixed, which is to be settled after 2 years. So it is settlement takes place after 2 years, and initial payment B Limited is required to pay an option premium to A Limited. The option premium is amounting to rupees 10 crore, which is in case if the consideration is for 500 crores, so 10 crores is an insignificant amount because it is less than even 5%. So B Limited, who is an option buyer, holds the shares of A Limited, and A Limited, who is an option writer, who gives option to B Limited to sell fixed number of equity share for rupees 500 crore after 2 years. Option premium is rupees 10 crores. So whether it is a derivative transaction having, yeah, it's a derivative transaction. How? Let's explain. Because it is having an underlying value which is share. Shares of A Limited is an underlying asset because A Limited is dealing in its own equity share. Settlement happen in own equity instrument, and number of shares are also fixed and consideration is also fixed. So it's fulfilling the definition of equity. Settlement happens in a future date, that is after 2 years, and initial payment is insignificant because 10 crore is insignificant in case settlement happens of amounting rupees 500 crore, which is less than, even less than 5%. So hence it is fulfilling the definition of derivative transaction. Suppose there is a note in order to explain this is a put option. As we know that put option is also a derivative transaction since settlement is happening for fixed number of equity own instrument of A Limited. It would be classified as equity, pure equity derivative. We had also discussed this concept equity transaction along with financial instrument. That is, we had discussed the compound financial instrument where there is a equity component and liability component. So the same concept is over here because derivative is there, and equity also fulfilling the definition of equity because it is how it is because number of shares are also fixed, consideration is also fixed, and A Limited settlement takes place in own equity instrument. So since A Limited is a wider obligation, because to deliver cash after 2 years, it's a financial liability is to be credited at present value, because since A Limited has to deliver cash after 2 years, obligation to pay cash arises when B Limited exercise its option after 2 years. Then there is an obligation in the hand of A Limited to pay cash. That time it is a financial liability which is to be recognized at a present value. So after what it would be done, it would be pulled by 5%, which is the market rate for 2 years. So pulling of that in order to bring it at a present value, at a fair value. So how to pull? We have to already learn how to pull calculation of financial liability. That is, there is a consideration of 500 crores. After 2 years, A Limited need to pay when B Limited exercise its option. B Limited is the holder always in a favorable situation. If B Limited exercise the option, A Limited is having an obligation to pay cash. So it is 500 crores at the rate. In order to bring it at present value factor, so 5% is the market rate for 2 years. So in order to bring out, to pull that 5% at today's value, so it becomes 453 crores. Now journal entry in the books of A Limited in year 0, because A Limited is receiving only the premium amount at the initial stage. At the time of making the contract, at the time of entering a contract, option contract, A Limited only receives the premium amount, that is amounting to rupees 10 crore. So he will book a bank account debit, because it's a equity transaction, not a liability transaction. So it would be credited to other equity, because premium is to be received. A Limited is entering into own equity instrument. So he will credit, A Limited will credit other equities, because it's a premium amount and it's not an equity right now. So other equity they will credit, not a financial liability. So bank account debit by 10 crores to other equity by 10 crores. And at the year 0, it also bring that consideration at present value factor by pulling it at 5%, which is the market rate for 2 years. So what they will recognize, because it is an equity instrument, dealing in own equity instrument, so they will recognize it as, because there is a buyback of its own equity instrument. A Limited will buy back its own equity instrument, so other equity buyback account debit by, because right now he is not going to pay anything and he is not going to receive the shares right now in own equity instruments. So what he will do, he will recognize the other equity as buyback account debit by present value, but at fair value, that is 453 crores. No reimbursement, because it is in own equity instrument, and what he is to pay at after 2 years, he will credit that. He makes a liability component of put option by rupees 453 crore, because after 2 years A Limited needs to pay 453 crores. So he will recognize liability today. So if he will credit the liability, what he will debit, he will not debit any asset, he will not debit any other liability, he will not debit any. So in year 1 he will recognize the amount as finance cost account debit by 22.68 crores to liability component of put option by 22.68 crores, because he has to recognize the other equity or liability component today at year 0 at fair value. So the differential amount of consideration after 2 years, yeah, is recognized, is amortized by A Limited as finance cost. So in year 1 he will recognize finance cost account debit to liability component of put option by how much? 453.51 into 5%, that is 22.68 crores. Account debit, that is finance cost account debit by 22.68 crores. How it comes? It comes by 453.51 into 5%. To liability component 22.68 crore. In year 2, he will recognize the same as 453.51 plus 22.68 into 5%, which becomes 23.81 crore. He will debit the finance cost by 23.81 crore and credit the liability component of put option by 23.81 crore. So at the date of settlement, the balance becomes, in year 2 the closing balance becomes financial liability he has to pay 453.51 plus 22.68 plus 23.81, it becomes 500 crores. Other equity put option, that is the premium amount which is paid on year 0, it becomes 10 crore, and other equity becomes 453.51 crore. So the balance is on the date of settlement, that is the closing balance at year 2 becomes this. Now if the A Limited will settle, the settlement happens? Let's. So on the date of settlement, if in case option holder, that is the B Limited, will exercise the option, then what the accounting entry will be? He will if the holder will exercise the option, then liability component of put option, which is recognized by A Limited as liability, reverse the liability, that is liability component of put option by 500 crore to bank account, because he needs to pay that. So liability become settled if the holder will exercise the option. And what he will recognize as, if holder has the option to recognize, then liability is settled. A Limited will pay the 500 crores to B Limited and liability will over. So जो अदर इक्विटी उसने बायबैक डेबिट कर रखा था उसको रिवर्स कर देगा और क्रेडिट कर देगा टू अदर इक्विटी बोल के, और उस अमाउंट को वो सेटल कर देगा प्रीमियम के साथ. तो प्रीमियम उसका 10 करोड़ का था, तो उसको सेटल करेगा और बैलेंसिंग अमाउंट जो है वो इक्विटी शेयर कैपिटल या रिजर्व में डाल देगा. So in this way he will make the settlement. In case if the option holder does not exercise the option और option lapse हो जाता है, तब क्या होता है? Liability component of put option account debit by 500 crore debit किया to other equity buyback 453.51. बैलेंसिंग जो अमाउंट है डिफरेंशियल बिटवीन बायबैक और लायबिलिटी कंपोनेंट, उसको रिटेन अर्निंग में ट्रांसफर कर देगा, और जो प्रीमियम का अमाउंट है उसको भी रिटेन अर्निंग में ट्रांसफर कर देगा. तो अगर लैप्स हो जाता है तो जितना भी वो लायबिलिटी और इक्विटी और बायबैक जो भी खड़ा किया था उसको रिटेन अर्निंग में ट्रांसफर कर देगा, और एक्सरसाइज करता है तब वो पे कर देगा, और जो भी अमाउंट उसने डेबिट क्रेडिट करके रखा उसको इक्विटी शेयर और रिजर्व में ट्रांसफर कर देगा. So in this way equity derivative is settled if in case of option. Now embedded derivative. What is an embedded derivative? What is a derivative? Derivative is a instrument that derive its value from its underlying asset. An embedded derivative is a hidden contract in a derivative instrument. Any derivatives hidden in a contract is an embedded derivative. Means if any contract is there and if any derivative is there in that contract is an embedded derivative. Means there is a one is the main contract and the topping on that is a derivative, that is an embedded derivative. Suppose the main contract is to purchase an instrument, and if the contract is prepared for commodity transaction, suppose we are taking the example of commodity or settlement happens on a net basis, so it's a derivative transaction. So if the contract and initial margin required to pay is nil, insignificant settlement happens after at a future date, and it derive its value from the underlying asset. So it's a derivative fulfilling the derivative, and it's a non-financial transaction. So if any contract, if any host contract is in embedded derivative, it's a hybrid instrument which consists of two instruments, that is host contract, that is the main contract, and also the derivative contract. So in one contract it is a combination of two contracts like host contract and derivative contract. So that type of contract is treated as an embedded derivative. Suppose example of embedded derivative, some of the examples we are taking in order to explain what kind of transaction is treated as an embedded derivative transaction. Suppose nature of transaction or host contract. Host contract means the main contract. Suppose there is a lease contract where lease payment is dependent on the consumer price index. There is a lease contract, and that lease payment is dependent on the market consumer price index. So market price index. So change in lease payment is due to CPI, is an embedded derivative, because there is a, if consumer price index, that contract is also is treating as a variable transaction. So in that case, derivative contract is the change in lease payment due to consumer price index. And if there is any convertible debenture based on the fair market value of the equity shares. Suppose in any debenture depend on the market price, so conversion option. In this case, the derivative will be conversion option dependent on the equity shares, is an embedded derivative. Whether they will option is exercised or not, it depend on the share price of the equity shares, is also an embedded derivative. So note will be, there is a lease contract where payment is linked to consumer price index, and thus this linkage of payment to consumer price index is an embedded derivative, and this lease contract is an host contract. Means main lease contract is an host contract. How we will make the accounting entry of embedded derivative? Or derivative is always recognized through fair value through profit and loss account, and accounting will be same as that of the derivative, because embedded derivative is same as that of the derivative. But in case of gain, recognize as derivative asset account debit to PL other income. In case of loss, PL expense account debit to derivative liability. Now accounting of host or hybrid contract. How host contract, that is the main contract, or hybrid contract means it's a mixture of host and derivative contract. So how accounting is to be done for that? Where the hybrid contract is designated at fair value, then it will be recognized through fair value through profit and loss account. No need to segregate the embedded derivative. Means if it is designated at fair value, so no need to segregate the host contract and the derivative contract. If the where the hybrid instrument is not designated, if it is not designated and fair value, then evaluate whether the embedded derivative is to be separated or not, whether we will able to separate that embedded derivative or not. If separated, अगर separate हो सकता है, embedded derivative to be recognized as fair value through profit and loss account, and host contract be accounted as per the classification principles of INDAS 109. Means host contract is to be recognized as per INDAS 109, and embedded derivative, that is derivative, be recognized as per through fair value through profit and loss account if it will be not designated at fair value. And if it is always designated at fair value, then it will be recognized at fair value through profit and loss account. No need to segregate that embedded. Economic characteristics of host contract is different with embedded derivative. If they are different, how it is, if they are different with embedded derivative, means in this case we have discussed, means if if they are not closely related with host contract, then what happens? When embedded derivative is not closely related with host contract, the embedded derivative is to be segregated. If it is not related, then it should be segregated from host contract. If it is related with the host contract, like call option, put option, prepayment option, in case of debt instrument, foreign currency loan instrument linked with inflation factors, like interest rate is based on LIBOR plus 0.3%, MIBOR plus 0.7, closely related. And if it is not closely related, then it should be segregated from host contract. And this is to be explained with the help of example. Suppose A Limited is an Indian company located in India purchasing a machinery from a foreign company located in USA. So A Limited is an Indian company located in India which purchased a machinery from foreign company which is located in USA. The date of forward contract is on 1st September 2023 for delivery of machinery on. Delivery takes place on 31st December 2023 at the rate 67.8 per dollar. Spot rate of making the contract. On the date of making the contract, the rate of dollar becomes rupees 66.4 per dollar. Purchase of machinery is at rupees 10 lakh dollars. Rate of forward contract on at the end of September, that is 30 September 2023, becomes 67.5 per dollar. Spot rate of forward contract on the date of settlement, that is 31st 12 2023, is 67. Means spot rate is always is given. Spot rate or forward rate on the date of making the contract is also given. Spot rate on the date of making the contract is given, and rate of forward contract on 30th September is also given. So how the accounting entry is to be recognized? How? Firstly, we will evaluate whether it's an embedded derivative or not. Evaluation of embedded derivative. Since the functional currency of A Limited and B Limited is in INR, however, the contract is denominated in USD. That is, the value of contract is dependent on the change in foreign currency. So initial payment, no initial payment is required because no initial margin amount is to be paid, and value of foreign currency to be decided in future. Settlement happen in a future date. Thus, the change in foreign currency, that is USD, is an embedded derivative because there is one contract to purchase a machinery which is a non-financial asset, that is PPE, that is a non-financial instrument, and derivative is a topping on that contract, like because it is denominated in foreign currency, and that foreign currency is depend on the foreign market rate which is fluctuated, and because no initial contract amount is paid and settlement happen at the future date. So this will fulfill all the definition of requirement of the definition of embedded derivative. So there is a main contract, that is the host contract of purchase of machinery, and it will be denominated in foreign currency, so it fulfill the definition of embedded derivative, because on the host contract there is a topping on that, that is the embedded derivative is a topping. So it fulfill the definition of hybrid contract. Accounting of hybrid embedded derivative. How it is to be accounted for? Embedded derivative needs to be accounted at fair value through profit and loss account, that is change in fair value is to be recognized in PL, because the derivative always accounted through fair value through profit and loss account. Any change is to be recognized in PL. In this case, the host contract is purchase of machinery contract, and derivative contracted contract is the denomination in USD, because the contract is to be denominated in foreign currency, that is the third currency, and that Third currency is a variable, depend on the variability of foreign currency index, foreign currency price. Now journal entry will be on 1st September, on the date of making the contract, the means A Limited will recognize in its book as, because he is not going to pay anything, and on first at the time of making the contract, and it's a derivative contract. So on 1st September 2023, that is on initial recognition, no accounting entry for derivative is to be done, because no payment, he is not going to pay anything, and for purchase of machineries. So he will not account for any derivative for purchase of machinery. No accounting is to be done for the host contract and for the main for the derivative contract. So for both the contract, no accounting entry is to be done at the initial stage at the time of making the contract, because the value of derivative is zero in case, and the contract date of delivery of the asset takes place on the date of settlement, that 31st December 2023. So at the time of settlement only, when he needs to pay anything and receive any asset, then only he will recognize. On 30th September 2023, he will recognize the fair value fluctuation only, because it is a currency transaction embedded in currency. So he will recognize the change in fair value due to movement in currencies. So he will recognize, in this case, he will make a contract for 67.8. Day on 30th September, it becomes 67.5. So in this case, he will recognize 3 lakhs on 30th September 2023 at fair value. The differential amount, derivative asset account debit by 3 lakhs to PL other income as 3 lakh gain on derivative. How it becomes? 10 lakhs is $10 lakh is there, at the contract price is 67.8, and the spot rate on 30th September 2023, it becomes 67.5. So 10 lakhs into 67.8 minus 10 lakh into 67.5, so it becomes 3 lakh. So it's again, because contract is prepared, because contract is prepared for 67, but there is a market rate goes down, because he has to pay, in that case he has gain the gain, because he has to pay less. 31st December 2023, on that is on settlement date, the price of the forward contract becomes 67, and the contract is prepared for 67.8. So he has gained amounting rupees 8 lakhs gain. So there is a gain of 8 lakhs in this case, because he has already recognized 3 lakhs as derivative asset. He will recognize only the balancing amount, that is 5 lakhs. So derivative asset account debit 5 lakhs to PL income by 5 lakhs, because he had already recognized the amount 3 lakhs. But when he actually received the asset, then what he will do? He will recognize the PPE by the contracted amount, that is 10 lakhs dollar at 67.8, that is 6 crore 78 lakhs. He will reverse the entry previously recognized, which will be the derivative asset. He will make the settlement, and by how much? He will recognize derivative asset by 8 lakhs, so he will reverse that 8 lakhs. He will credit the derivative asset by 8 lakhs. That is, if it will be settled, or he will pay the amount, then he will make a credit of bank to bank, or if it will not make a payment, he will recognize to trade payment by 6 crore 70 lakhs. So PP account debit by 6 crore 78 lakhs to derivative asset by 8 lakhs to trade payable 6 crore 70 lakhs. Thanking you for watching my video. If you like, please share, subscribe my channel.